If you've ever lost money in the stock market, if you've bought stocks based on hype and watched them crash, if you're confused by all the conflicting investment advice, this audio is for you. Today we are breaking down The Intelligent Investor by Benjamin Graham, the book Warren Buffett calls the best book on investing ever written. This isn't about getting rich quick. This is about protecting your money and building wealth steadily over time. The principles in this book have survived every market crash for 75 years and they work just as well today. Before we start, please hit that like button, leave a comment, and subscribe to support this channel. It takes 2 seconds and helps us create more content like this for you. Benjamin Graham is the father of value investing. He survived the 1929 crash, lost almost everything, and spent 50 years developing a system to invest without losing your shirt. This book introduced revolutionary concepts: value investing, margin of safety, and Mr. Market. Warren Buffett read this at 19 and says it changed his life. Everything Buffett knows about investing came from this book. When the greatest investor ever says this is the best investing book, you should listen. First, understand the difference between investing and speculation. Investment means buying something after thorough analysis, focusing on safety first and adequate returns second. Speculation means buying something hoping the price goes up, with no real analysis. Most people think they're investing when they're actually speculating. They buy stocks based on tips and hype, not value. That's gambling, not investing. Who is an intelligent investor? Graham says it's not about IQ or education. You need 3 things: patience, discipline, and willingness to learn. That's it. Character matters more than intelligence. The market rewards patience and discipline, not genius. Now, let me introduce you to Mr. Market. This is Graham's most powerful concept. Imagine you own part of a business and have a partner named Mr. Market. Every day, he offers to buy your share or sell you his at a certain price. Here's the problem: Mr. Market is insane. He's emotional, sometimes euphoric, sometimes depressed. Some days he offers ridiculously high prices. Other days absurdly low prices. The key insight: Mr. Market is there to serve you, not guide you. You don't have to accept his prices. Only deal with him when it benefits you. When he's euphoric and prices are high, you can sell. When he's depressed and prices are low, you can buy. Or you can just ignore him completely. The stock market is not a wise authority. It's an emotional crowd swinging between fear and greed. Price is what Mr. Market offers today. Value is what the business is actually worth. Smart investors know the difference and take advantage when price and value don't match. This brings us to margin of safety, the most important concept in the book. Never pay full price for anything. Always buy at a significant discount to intrinsic value. Why? Because you might be wrong. Your analysis could be flawed. Unexpected problems happen. Margin of safety is your buffer against mistakes and bad luck. Think of a bridge with a 10,000-pound limit. You don't drive a 9,000-pound truck across. You drive a 5,000-pound truck. That cushion is your safety margin. In investing, if a stock is worth $100, don't buy at $95. Wait for $60 or $70. That 30 to 40% discount protects you when things go wrong. Margin of safety works with diversification. Individual stocks can fail. Even great companies face disasters. Never put all your money in one or a few stocks. Spread across many companies and industries. If 1 or 2 fail, they won't destroy your portfolio. Diversification is insurance against unpredictable futures. Graham identifies 2 investor types: defensive and enterprising. Defensive investors want satisfactory results without much effort. Most people have jobs and families. They can't spend hours analyzing stocks. The defensive approach: invest half in bonds, half in quality stocks, rebalance yearly, don't try timing the market. This is low maintenance and delivers adequate returns. Enterprising investors put in substantial time and effort for above-average results. This isn't gambling, it's serious work. They research deeply, calculate values, hunt bargains, and actively manage portfolios. This can deliver better returns but requires real skill, time, and discipline. Most people think they're enterprising investors when they're just speculators. Which should you be? Depends on your time, knowledge, and temperament. Be honest. Most people should be defensive investors. A defensive investor following their strategy will beat someone pretending to be enterprising but actually speculating. And if you appreciate this breakdown, don't forget to hit that like button and subscribe. It really helps us grow. For defensive investors, Graham recommends 50-50, half high-grade bonds, half quality stocks. When stocks rise and become more than 50%, sell some and buy bonds. When stocks fall below 50%, sell bonds and buy stocks. This forces you to buy low and sell high automatically, without timing the market. For stocks, choose blue-chip companies, large, established businesses with long profit histories and dividend payments. Don't hunt for hidden gems. Buy boring, stable companies that have existed for decades. For bonds, stick to high-grade government or corporate bonds with solid ratings. The goal isn't maximum returns, it's satisfactory returns with minimum risk and effort. One crucial rule: don't trade frequently. Buy and hold long-term. Trade only twice yearly when rebalancing. Frequent trading creates costs, taxes, and mistakes. It turns you into a speculator. The defensive strategy works because it's boring, stable, and low maintenance. For enterprising investors, find undervalued companies, stocks trading well below intrinsic value. How? Through fundamental analysis. Study financial statements, analyze business models, evaluate management, calculate actual worth. Compare intrinsic value to market price. If market price is substantially below intrinsic value with a margin of safety, you have an opportunity. Hold 10 to 30 different stocks. More than 30, you can't analyze them properly. Fewer than 10, you're not diversified enough. This range protects against failures while remaining manageable. Graham provides specific criteria for selecting stocks. Look for companies where the PV ratio is below 15, meaning you're not overpaying for earnings. These criteria might sound restrictive, but that's the point. Graham wants you to be selective and patient. Most of the time, most stocks won't meet these standards. That's fine. Wait for opportunities that do. Let's talk about inflation and your portfolio. Cash is a terrible long-term investment because inflation erodes its purchasing power. If inflation runs at 3% annually, your cash loses half its value in 24 years. This is why you need stocks. Historically, stocks have beaten inflation over long periods. But here's what matters: real returns versus nominal returns. If your stocks return 8% but inflation is 3%, your real return is only 5%. Always think in real terms. This requires a long-term perspective. In any given year, stocks might lose money. Over 10 or 20 years, they almost always beat inflation and bonds. The defensive investor's 50-50 split protects you from short-term volatility while keeping you invested for long-term growth. Now let's address common mistakes that destroy investor returns. First, market timing doesn't work. People try to buy before markets rise and sell before they fall. Sounds great, but nobody can do this consistently. Even professionals fail at it. Graham's research showed that market timers underperform simple buy-and-hold strategies. Don't try it. Second, forecasts and predictions are dangerous. Every day, experts predict where the market is going. They're almost always wrong. Graham says you should completely ignore all market forecasts. They're noise, not signal. Focus on analyzing individual businesses, not predicting market movements. Third, emotional decisions kill returns. When the market crashes, fear makes people sell at the bottom. When the market booms, greed makes people buy at the top. This is exactly backwards. The intelligent investor does the opposite of what emotions dictate. Buy when others are fearful. Sell when others are greedy. This is incredibly hard because it means acting against your instincts and against the crowd. Fourth, herd mentality is deadly. When everyone is buying something, it feels safe and smart to join them. But when everyone wants something, prices get pushed too high. The best opportunities come when nobody wants something and prices are depressed. Be contrarian, not conformist. Fifth, growth stocks get overvalued. Companies with exciting stories and high growth rates attract attention. Everyone wants to own the next Amazon or Tesla. This pushes prices to absurd levels. Graham warns repeatedly about overpaying for growth. A great company at a terrible price is a terrible investment. A mediocre company at a great price can be a great investment. Price matters more than the story. Graham's writing style is practical and direct. He uses historical examples and case studies, comparing real companies to show what works and what doesn't. The book has passed a 75-year test. The principles still work in completely different market conditions. That's the mark of timeless wisdom. The book's greatest strengths: first, the principles are truly timeless. Technology changes, markets evolve, but human psychology stays the same. Fear and greed drive markets today just like in 1949. Second, this book popularized value investing and made it accessible to regular people. Before Graham, investing was mystical and speculative. He made it systematic and logical. Third, the concepts of Mr. Market and margin of safety are brilliantly simple yet profound. Once you understand them, you see the market completely differently. Fourth, the book works for any investor, beginner or experienced, small portfolio or large. The principles scale. And fifth, Warren Buffett's endorsement isn't just marketing. He genuinely built a $100 billion fortune following Graham's principles. Now the weaknesses. Some numbers and examples are outdated. Graham wrote in a different era with different tax laws and market structures. Some specific recommendations don't translate directly to today. Second, the approach is very conservative. If you're young with decades to invest, you might want more aggressive strategies. Graham's focus on safety means you'll miss some high-growth opportunities. Third, the book doesn't cover modern derivatives, ETFs, index funds, or many instruments available today. Fourth, valuing technology companies is difficult with Graham's metrics. Tech companies often have high P/E ratios and don't pay dividends, yet some are excellent investments. Graham's criteria might screen them out. And fifth, this book doesn't guarantee you'll beat the market. It teaches you how to avoid losses and achieve satisfactory returns. That's different from maximum returns. Who should read this? New investors learning the fundamentals. Anyone who's lost money and wants to understand why. Long-term investors focused on decades, not days. Anyone wanting to reduce risk. Warren Buffett fans who want to understand his philosophy. Anyone interested in value investing strategy. How does it compare to other classics? Security analysis by Graham is more technical and detailed. It's for serious students. Common Stocks and Uncommon Profits by Philip Fisher focuses more on growth investing and management quality, a good complement to Graham. A Random Walk Down Wall Street by Burton Malkiel argues for index funds and efficient markets, a different philosophy but worth reading. One Up on Wall Street by Peter Lynch is more accessible and focuses on finding growth opportunities. The Little Book of Common Sense Investing by John Bogle makes the case for index funds over stock picking. If you're learning a lot, please take a moment to hit that like button and drop a comment below. And subscribe so you don't miss our next book summary. Let me give you the 7 key takeaways. First, investment is not speculation. Always know which one you're doing. Don't gamble while thinking you're investing. Second, treat Mr. Market as your servant, not your guide. The market offers opportunities. It doesn't tell you truth. Third, always apply margin of safety. Never pay full price. Buy with a significant discount to protect against mistakes. Fourth, diversify to spread risk. Individual stocks can fail. Your portfolio shouldn't. Fifth, take a long-term perspective. Patient investors win. Short-term traders lose. Sixth, control your emotions. Fear and greed are your enemies. Discipline is your friend. Seventh, learn to calculate intrinsic value. This is the foundation of everything. If you can't value a business, you can't invest in it intelligently. Now for practical steps. First, decide if you're defensive or enterprising. Be honest about your time, knowledge, and temperament. Second, create your portfolio balance. The classic is 50-50 stocks and bonds, but adjust based on your situation. Third, use Graham's criteria when selecting stocks PV below 15, PB below 1.5, dividend history, financial stability, 10 years of consistent earnings. Fourth, always buy with margin of safety. If you calculate a stock is worth $100, don't buy above 70. Fifth, don't let Mr. Market's mood affect you. Ignore daily price movements. Focus on long-term value. Sixth, rebalance your portfolio once or twice yearly. Sell what's risen above target, buy what's fallen below. Seventh, learn fundamental analysis. Study financial statements. Understand businesses. This is the real work of investing. How to use this book. Read it first to understand the foundations. Reread yearly. You'll discover new insights each time. Before every investment decision, consult Graham's principles. Create a checklist of criteria and check every potential investment against it. Keep an investment journal recording your decisions and reasoning. Review it regularly to learn from successes and failures. Discuss these ideas with other serious investors. Similar books to read. Security Analysis by Graham and Dodd goes deeper into technical analysis. Common Stocks and Uncommon Profits by Fisher adds the growth perspective. One Up on Wall Street by Lynch is more accessible and practical for individual investors. The Little Book That Beats the Market by Greenblatt simplifies value investing into a formula. The Essays of Warren Buffett shows how Buffett applies Graham's principles. A Random Walk Down Wall Street by Mulcahy presents the case for index investing. Final thoughts. This book is the investment Bible. 75 years later, the principles remain unchanged. This isn't about getting rich quick. It's about building wealth steadily while protecting your capital. Capital preservation comes first. Growth comes second. Value investing is the most reliable long-term strategy. And remember, character matters more than IQ. Discipline, patience, and emotional control beat intelligence and analysis every time. If you found this valuable, please hit that like button one more time, subscribe to our channel, and drop a comment below. Tell me, are you a defensive or enterprising investor? What was your biggest investment mistake? Do you use value investing principles? I genuinely want to hear your thoughts. Coming up next, we'll analyze either Common Stocks and Uncommon Profits by Philip Fisher or One Up on Wall Street by Peter Lynch. Let me know in the comments which you want first. Thank you so much for your time and attention. That's the most valuable investment of all. Remember, you're not trying to beat the market. You're trying to avoid losing money while building sustainable wealth. Invest intelligently, stay disciplined, and your future self will thank you. See you in the next video.